If you don't know what just happened with the Fed, you're already behind. And in this game, being behind costs money. This week, Jerome Powell stood at Jackson Hole and dropped a line every investor should have etched in stone. Miss it, and you're the person still wondering why your portfolio feels like a theme park ride. Know it, and you've got the cheat codes to protect and grow your wealth. Welcome back to the club. Jerome Powell, up in Jackson Hole, let slip something that changes the game. The job market is softening, and that means the Fed is warming up to cut. Now, you might hear that and think, perfect or terrifying. And if you're a dividend investor, especially someone relying on steady income in retirement, this is one episode you absolutely shouldn't miss. Powell's tone was a clear shift. For 2 years, the Fed has been laser-focused on inflation. But now Powell is openly worried about jobs. That means the Fed is preparing for cuts. And here's why that's such a big deal. Rate cuts don't just tweak the economy. They flip the switch on the whole stage. Mortgage rates can drift lower, corporate borrowing becomes cheaper, and suddenly, sectors that felt frozen start moving again. When the Fed heads this way, long-term treasuries and quality corporate bonds can rally, sometimes like an encore no one expected. If you've been hiding in cash or money market funds, know this: those yields won't last. Bonds are back in the spotlight, and stocks usually catch a tailwind too, especially growth and tech names that thrive when money loosens up. Gold, it loves a weaker dollar, so expect it to sparkle even brighter. But here's the twist. This isn't a guaranteed rerun of the easy money years. Back then, when rates dropped, everything from meme stocks to crypto shot up together. This time could be different. Inflation risks remain, governments are actively pulling strings, and not every asset will ride the same wave. Growth sectors tied to technology, AI, and strategic industries could soar as borrowing costs ease, while gold and long bonds may gain strength as safe havens. On the flip side, traditional banks could feel the squeeze. Speculative meme plays and fringe crypto may not light up like they did before, and sitting too heavily in cash will feel like watching your paycheck evaporate. The message is simple. Don't panic about the pivot. Understand what it unlocks, know who the likely winners are, and don't assume it's a replay of the last cycle. Position smartly and get ready to ride it. Now, while Powell was measuring every syllable, Washington pulled a move that felt like a plot twist straight out of prime time: rescuing Intel. Yes, the US government is considering buying a piece of the company. That's not just a bailout. It's a neon sign flashing that national security now equals industrial policy. Politically, it shows America isn't shy about bending free market rules when it believes certain industries are too strategic to risk. Economically, it means direct government money flowing into chips, energy, and defense, creating a safety net for chosen sectors and tilting the playing field. And for Intel owners. In the short term, government support could stabilize shaky finances and speed up those delayed projects like its Ohio foundry. The stock might enjoy a policy-driven boost, with a sense that Washington won't let it fail. But here's the catch. Intel's recent record, lagging TSMC and chip technology, manufacturing delays, and billions in foundry losses, won't disappear overnight. Government backing buys time, not guaranteed dominance. Market sentiment will also hinge on how the deal is structured. If the government buys shares outright, existing owners could face dilution. If it comes through preferred stock or loans, it might strengthen Intel's liquidity without shrinking shareholder value. Either way, confidence in Intel's survival gets a boost. But the long-term payoff still depends on whether the company closes its technology gap. For long-term shareholders, it's a reminder. Intel may have a safety net, but execution is still the high-wire act. For us as investors, semiconductors, Intel, Micron, GlobalFoundries, are back on the radar. Defense contractors like Boeing and Lockheed remain steady stars, and critical mineral players like MP Materials and Centrus Energy are suddenly headliners. But if you're TSMC, Samsung, or a smaller, unprotected tech outfit, the spotlight isn't on you. Governments are picking winners, and a little diversified exposure could give your portfolio the same tailwind. And here's where it gets spicy. While Washington was busy playing kingmaker, Wall Street's big names were quietly reshuffling their playlists. Buffett trimmed his beloved Apple but doubled down on United Health. And here's something to remember. 13F filings like this are always delayed snapshots. What we see now is Berkshire's lineup at the end of June, not today. It's still one of the best windows into the thinking of the world's most famous investor. But it's not a live stream. And his move? Not random. It's a bet on resilience. Bridgewater and Tepper, meanwhile, dropped their China exposure and loaded up on AI hardware, NVIDIA, Micron, even some TSMC. Home builders like Lennar and D.R. Horton also caught attention as investors gambled on lower mortgage rates. What do we learn here? Copy the rhythm, not the exact notes. They didn't abandon the market. They rebalanced. They trimmed old branches and planted new seeds. China equities are being ghosted. Megacaps like Apple might get shaved back. And speculative fintechs like Robinhood and SoFi are left out in the cold. The message from the pros: stay in the game, but play it smart. So what's the takeaway for us? The strong players look to be U.S. growth and AI equities, strategic industries like defense and energy, long bonds, and gold. Add healthcare and dividend stocks for resilience, and you've got a sturdy mix. And for those of you living off dividends in retirement, this is even more crucial. Rate cuts mean those high cash yields will shrink, but steady dividend payers in defensive sectors can keep the income flowing. Think of them as your paycheck replacements when money market funds stop delivering. And here's the reassurance. Dividend strategies have always been one of the most reliable tools for retirees. Even when Fed policy shifts, quality dividend payers, from utilities to consumer staples to healthcare, have a long history of keeping those checks coming, regardless of market noise. What to be cautious with? Cash-heavy strategies, over-leveraged banks, speculative tech, and China equities. The winds are shifting, but if your roots are deep and your branch is flexible, you'll bend, not break. This week wasn't noise. Powell's pivot, Intel's safety net, and Buffett's rotations are signals. Together, they whisper the same advice. Stay calm, stay diversified, stay invested. Protecting wealth isn't about locking yourself in the basement during a storm. It's about learning to dance in the rain and maybe even enjoy the beat. So here's my final thought. Knowledge like this separates the investors who stumble from the ones who thrive. If you've stuck with me this far, you're already ahead. Keep building on it. If this video showed how central banks and governments can move markets, our previous video on the Genius Act takes it even further. It unpacks how a new law is shaking up digital dollars and stablecoins, and why it matters for your money. Just like Powell's warning and Intel's Lifeline, the Genius Act proves policy doesn't sit quietly in the background. It grabs the mic and changes the show. That video gives you the essentials, the traps to dodge, and the smarter ways to invest in this new landscape. Stick with the plan, and your wealth won't just survive this cycle. It'll come out stronger, steadier, and smarter. And if you found this breakdown valuable, hit that like button, subscribe, and ring the bell. That way you'll never miss when we turn the week's chaos into clarity for your portfolio.